Good afternoon and welcome to another online video training brought to you by lowvarate.com. Today we are going to continue to focus on the VA hybrid loan, and we're specifically going to focus on a question that we're asked a lot of times by veteran and military homeowners, and that is they do not want a hybrid loan because they feel that the 30-year fixed mortgage is safer. That's not always the case. Very rarely is it the case, and this simple guide will help you understand how the VA hybrid loan is actually a safer long-term and short-term loan than. So here are some common beliefs about the 30-year fixed mortgage. First of all, most of us believe that it's a safer mortgage than the hybrid or the ARM loan. We believe it's better for people who want to pay off their home loan quicker or pay it off early or just pay it off. We also feel that the 30-year fixed is better for someone who wants to live in the home for a long period of time or perhaps forever. I hear on a daily basis, you know, Eric, I'm going to die here in this house, and that's why I want the 30-year fixed. I also hear that it's much easier to budget our finances with a 30-year fixed rate as opposed to a hybrid. It's also apparently much easier for someone on fixed income or someone who's approaching retirement to stay on a fixed rate as opposed to a hybrid loan. Now here's some common beliefs about the VA hybrid loan. First of all, most people feel they're dangerous when compared to a fixed rate. They also feel that the hybrid loan is only good for someone who does not want to pay off their home, doesn't really care what happens to the balance. People also assume that the VA hybrid loan is intended for someone who's going to be moving soon or does not plan on being in the home for a long period of time. Now this is true. It is good for someone who's going to be in their home short term. However, it does not mean that it's only intended for those people who are going to be moving. Some people also believe that it is very hard to plan or budget because the future payments are always going to go up on a hybrid loan. Well, that's not even remotely true. And that the VA hybrid loan is not a good loan for someone planning to retire or planning to be on fixed income shortly. Now let's compare and contrast the 30-year fixed loan and the VA hybrid loan. First of all, I think we need to define safe. The online dictionary says that safe is secure from danger or harm or affording protection. Well, how can we be safe in our homes or secure ourselves from danger? I can tell you right now it has nothing to do with your loan. You can go out and get, homeowners want certainty for one thing. They want to know that their home is not going to fall down, or if it is, that it's going to be rebuilt. They also want to know that they can afford payments at any time, now and 5, 10, 15, 20 years from now. They want to know that they're going to be able to pay their bills and keep the power, heat, and lights on. This safe feeling obviously is important. But which loan is safer, the fixed or the hybrid? Well, based on our experience when dealing with military homeowners, most people speak of safety as it pertains to their home loan. Okay, so someone wants to feel safe in their loan. They mean they want to make sure that their payment's going to be fixed and that they're going to have the ability to make that payment forever. This is a natural thought, and it's a natural thought that the 30-year fixed rate will be the safest. However, when looked at in real life scenarios, there are much more times when the hybrid loan is actually safer, and we're going to cover that today. Now, why is the VA hybrid safer? First off, if you want to feel safe in your home, homeowners insurance, paying your bills on time, buying a home that's been built right and is of sound structure, that's how you can feel safe in your home. Now we're going to talk about how to feel safe in your mortgage. I would go as far as saying, yes, of course, the VA hybrid loan is much safer. Your payment is much, much lower. Now, if you're not aware of how that works, there are other videos and slides that you can search here on YouTube or on the internet to figure that out. But most people understand that the payment is much lower on a hybrid. The hybrid loan also allows you to pay your home loan down much faster. You're going to get out of debt and pay your balance off quicker on a hybrid loan than you will on a 30-year fixed. Now, the hybrid loan also allows you to save money for those rainy days, those unanticipated occurrences in life where maybe we lose our job, we get in a car accident, something happens where we need extra money and we can't keep up with our mortgage payment. Having been on a hybrid loan will have allowed you to save money for those situations. Now, the hybrid loan also allows you to pay off higher interest rate debt like credit cards at a much faster rate. I look very forward to one of our upcoming video trainings where I show you how you can get out of debt quicker with a hybrid loan than you can a fixed rate loan. Now, your 30-year payment on a 30-year fixed payment will still be $2,500 20 years from now. It does not matter if your balance is all the way down to $10,000 owing. The bank is still going to want $2,500 every single month, just like they were when you started with your $350,000 mortgage. So keep that in mind when you're thinking about how safe your 30-year fixed rate is. We're going to talk more about this as the presentation goes on. Now, which loan is better for paying off your home faster, the hybrid or the 30-year fixed? First, we need to know the facts. The USA is the only developed nation that offers the 30-year fixed rate in such abundance. Now, why is this? This is because almost no one keeps the exact same loan for 30 years. Now, you may say, well, then why do they offer it? As we've discussed in prior trainings, it's because the bank, Wall Street, the people offering these loans can charge you a higher rate and make a heck of a lot more money by convincing you to go into a 30-year fixed. But no one keeps their loan for 30 years. Ask yourself this: do you know one single person that has had the same loan for the past 30 years? You do not. I promise you, you do not know anyone who is still on the same loan today that they were 30 years ago. Now, in order to completely pay off your home, you need to do the following. First of all, you have to make additional principal payments. Remember, we're talking about which loan is better for paying off your home faster. You also either you're going to have to win the lottery, get a lump sum payment and pay your balance all off at once, or get some sort of an insurance payout or inherit some money. If that happens, then you're going to be able to pay off your home faster. Okay? You will not simply make the same payment year after year after year until your home is paid off. If you think that's what you're going to do, I've got a surprise for you. It will not happen. Okay? So which loan is better for paying off your home faster? Let's continue. Making additional principal payments is much easier on a VA hybrid. If you can afford a $2,500 fixed payment, your VA hybrid payment would be as low as $2,000, which means that you could afford to apply that extra $500 a month to principal. If we went back a slide, let's not forget the only way to get your balance paid off faster is to attack that principal, which the hybrid loan allows you to do. Now, VA hybrid loans, due to their extremely low interest rates, will normally pay down your loan balance up to $25,000 or $35,000 faster in the first 5 to 7 years. If you don't believe me, go to Google, type in mortgage calculator, and then go do a payment, go do an amortization schedule, and compare what your balance will be 5 to 7 years from now on a 6% fixed rate loan, and then go do it 5 to 6 years from now on a 3.5% loan. You will have gotten $25,000 to $35,000 lower on your balance on a hybrid loan than you would be on a 30-year fixed. Now, if you get an inheritance, win the lottery, or get an insurance payout, it's not going to matter which of these two loans you have. So if you plan on doing that, I really don't care which loan you use. Now, is the 30-year fixed rate better for someone who wants to be in the home forever? Again, whether or not you'll be in the home forever is really not a valid question. The question should be, do you plan on having your loan forever? Based on the last slide, it should now be realized that the VA hybrid loan is going to allow you to have lower payments, which then allows you to pay down your balance faster and put extra money into your loan when you want to. Whether or not you're going to retire and live in your home forever is not contingent upon the loan being fixed or hybrid. That's a completely different question. Yet, most people get confused and they take the wrong loan because of this right here. Now, which loan is better for budgeting, the VA hybrid or the 30-year fixed? Remember, if you have a $350,000 5.5% fixed rate for 30 years, your payment's going to be $1,987 a month forever. However, your taxes and your insurance, what we refer to as escrow, your escrow is going to go up, normally speaking, every single year, or at least over the long term. Your home value goes up, which means your insurance goes up, and your taxes go up. So your payment's never going to go lower than this, and most likely it's going to go up. Now, even when your balance is down to $50,000, you're still paying $1,987 a month. If you're thinking about retirement or living on a fixed income, what happens if you get injured or you're laid off or you get a pay cut? Will you be able to afford a $1,987 a month or more payment in the future? Makes it kind of hard to budget. A hybrid payment will be lower as your balance goes down even when the interest rate goes up. And we talk about that again in other presentations and other slides. But know that your payment will go lower on a hybrid loan even in those years where your payment goes up. For example, if you get the balance paid down to $250,000 and your hybrid rate hits 7%, your payment's still only $1,766 a month at the beginning of year 5. This is still $221 lower than your 30-year fixed payment would be when your balance is at $250,000. Why is this? It's because the hybrid loan is re-amortized every single year off of the new, lower balance. Your 30-year fixed loan, however, is never re-amortized ever, so your payment is always calculated off of the original balance of $350,000. Now, let's look at budgeting fixed income and retirement. Based on the last slide, it's now obvious, or should be, that the VA hybrid loan is safer for someone looking to have a fixed income or moving into retirement age. Assume you know you will only be making X amount of dollars for the rest of your life. Can you really afford to know that your mortgage payment may keep going up? Unless you're going to be paid off by now, having a 30-year fixed rate loan into retirement can actually be a bigger hindrance than most people are aware. Now, it's very important that you get the VA hybrid loan working for you. Does it work for everyone? Not always, but 9 times out of 10, if it doesn't work for you, it's because you don't understand it. I hope this presentation has allowed you to realize that most people are better off with a VA hybrid loan in the short term and in the long term. And if you think a 30-year fixed rate is safe, all you need to do is talk to the many, many people that went out and got 30-year fixed rate loans, having been able to afford those payments at the age of 30, 35, or 40, then something happens to them and their income changes. Their payment has gone up due to taxes and insurance. Their balance has gone down, yet they continue to have to stretch for that payment that they could afford when things were good and cannot afford now. If they would have been on a hybrid loan, they would have saved money, they would have put money away, and they would have paid that balance down a heck of a lot faster. In worst case scenario, they could have sold their home and gotten out of the loan, which they can now not afford. I hope this makes sense. Please call us toll free at 866-569-8272 and get a no obligation analysis on how the hybrid loan can help you. We look forward to hearing from you soon.